So look, I'm sure, no doubt, as has happened with many of you since the election, we've been asked a lot of questions about our views about what happened and why. And of course, as Trump's second term approaches, many have asked us about what we expect to happen. So we thought that on the eve of Trump's inauguration, it's a good time to look back at how we got here, both in the recent past and frankly, even in the further past. Um, there's lots to cover, and I apologize in advance for being a little pedantic, but I've tried to answer as many of the questions that we've already been asked that have been posed to us since the election as possible. And that means some things are going to get skipped over and some things are going to be oversimplified, but I've tried to organize the presentation in a way to cover a lot of material coherently, efficiently, and understandably in a very short period of time. And I hope that succeeds without being too boring. Um, so with that, I'll share my screen. Um, and let's hope this works. We've been having some interesting technical difficulties today, so let's hope the technical gremlins stay away. So here we go. Today's discussion is going to focus on four things. First, the immediate economic drivers of the 2024 election. Second, the long-term economic drivers leading to the 2024 election. Third, Trump's coming deregulation juggernaut. And fourth, the economic and financial and political consequences. So I want to start with the big picture, although talking at a high level will miss a lot of nuance. But before we get into the details, I thought this was important. So first, the economy hasn't worked for most Americans for decades. Second, while there were many reasons for that, a key structural driver is that the financial system often just no longer supports the real productive economy. That's largely due to the financial industry using its economic power to buy political power to expand and increase its economic power. Now, fourth, that results in the financial industry engaging in more high-risk financial activities that generate the biggest short-term gains for it in the top 10%. Some people call that financialization. Fifth, those activities come at the expense of everyone else because of the risks they create to the financial system and the economy, which leads to boom-bust cycles, crashes, bailouts, and recessions, if not depressions. And sixth, unsurprisingly, all of that has political as well as economic consequences. So a few heretical facts I'd like you to keep in mind. First, regulation is not bad. And I know people on Wall Street think lightning will strike me, but that's actually true. Regulation is not bad. And if they're a little more self-enlightened, they would realize it's actually in their interest because regulations are consumer, investor, customer markets, and financial stability protections. They are the foundations of our financial and banking systems because they give people faith, trust, and confidence in those systems. And that's why people put their money, the capital that fuels everything, into our financial and banking systems. It's because they are well regulated and well policed. Yes, those protections cost money, but the cost of not having them are much, much greater. The financial industry's claims of overregulation, frankly, are baseless and factually inaccurate, and we're going to go over a bunch of that. No matter how many times they say it, there's no overregulation of the financial industry. In fact, the facts are going to show the financial industry is woefully underregulated. And as a result, it is again engaging in far too many risks, high risk, dangerous, and antisocial activities. And when we talk about the coming Trump deregulation juggernaut, that will really be clear. So the inevitable result, that's inevitably going to lead to crashes and bailouts because the financial industry simply cannot prevent itself from overdoing it and going too far once deregulated. Once the massive pile of money is visible to them, they're going to engage in the activities that move that money from other people's pockets into theirs. And you don't have to believe me. Believe the former CEO of Morgan Stanley. This is a rare moment of Wall Street candor. This is the Morgan Stanley Chief Executive Officer, John Mack, who in November of 2009 said, quote, "We cannot control ourselves. You, lawmakers and regulators, have to step in and control the street. Regulators, we just love them," close quote. Now, unfortunately, there was a reversion to the mean, and I mean that in every sense of the word mean. John Mack's moment of candor and insight in the months after the catastrophic 2008 crash lasted only a moment. He quickly clammed up and disappeared for all intents and purposes. However, his fellow Wall Streeters and financiers went on the attack and engaged in one of the biggest lobby campaigns in history to try and kill any financial reform after the 2008 crash. I can tell you, I was a senior staffer in the United States Senate during this, and it was really quite unbelievable the degree to which, the amount of money which that they threw into trying to kill any legislation at all. Now, that failed to some extent. The Dodd-Frank financial reform law was signed into law in July of 2010, but the industry attacks had weakened it substantially, and those attacks actually increased afterwards in the rulemaking process. Now, Jamie Dimon famously said in January of 2010 that, not to be funny about it, he claimed, but when asked about what's a financial crisis, he said, well, that's something that happens every 5 to 7 years. Well, the funny thing about it is he was right, but for the wrong century. He was actually describing the prior century or so. So I promise I'm going to get to the 2024 election, but before we get to that, we need to quickly look at a few historical facts for context, and that means going back to 1800. Now, I know in Washington, history is usually thought of, what happened last week or frankly, even yesterday. But to understand today, we need to go back a little bit further. During this time, until the great crash of 1929, the country suffered from financial crashes every 10 to 15 years or so. Kind of like Jamie said, he was talking about real time in 2010, but he's wrong about that. The facts show that that's what happened in the 1800s up through the crash. During the 1800s, when those financial crashes happened every few years, they were called panics, and they caused frequent economic calamities. I bring that up because that's what we may be returning to in the future. Now, what stopped that pattern of frequent crashes were the reforms that followed the great crash of 1929. That's what led to broad and deep regulation of the financial industry until that changed around 1980 or so. It's really, really important to remember that the US economy thrived for most of the post-crash 20th century at the very time the financial industry was regulated more heavily than at any time in history. So if you look at the chart, you have FDR's structural reforms, regulation of the financial industry in the 30s. And then from about 1950 to 1980, you had the heaviest regulation of the financial industry in the history of America. And yet, at the same time, the broadest and deepest economic growth. Now, that all changed starting at about 1980, when deregulation tore down FDR's reforms and largely let the financial industry do what it wanted until the 2008 crash. And that's when we faced these 4 decades of deregulation from 1980 to 2024. And I mean to 2024. Sure, there were financial problems from time to time in the 20th century, but nothing like the 1929 crash until 2008. The 2008 crash was preceded by decades of massive deregulation. And contrary to the propaganda you've heard nonstop since then, that deregulation has largely continued through today. And that's what this shows you. This is from 1981 until 2025, literally to today. Now, yes, this overlooks some events like the S&L crisis, Sarbanes-Oxley, but the overall thrust is captured here. So in 44 years, in the last 44 years, we've had 32 years of widespread deregulation, 6 years of modest re-regulation, 4 years of rough status quo, and 2 years of historic industry bailouts. And that's as obvious. You go from 1981 Reagan, first Bush #1, all the way through Clinton, through Bush #2. You have massive, massive, consistent deregulation of the financial industry until they were largely unregulated and unpoliced and through the years leading up to 2008. Now, we have the big crash in 2008, the worst crash since 1929. And 2 years after that, what happens? The biggest bailouts in the history of the country. trillions of dollars get shoveled into the financial industry to save it from collapsing the entire economy. Now, the Dodd-Frank financial reform law was passed in 2010, and yes, we had about 6 years of some modest re-regulation. It's not regulation, it's re-regulation of the financial industry from roughly the passage of Dodd-Frank in 2010 until Obama left office in 2016. Now, as you know, that was followed by the first Trump administration, where there was pretty significant deregulation throughout those 4 years, rolling back some of the key parts of the re-regulation during Obama. President Biden came in and left most of that deregulation in place, especially in the banking agencies. Only at the CFPB, which has been outstanding in fulfilling its mission and mandate of protecting financial consumers, and to some extent at the SEC, was there some re-regulation. But think about this. The Fed under Trump enacted somewhere like 20 or 22 deregulatory rules. When he left office, that was the state of play in 2021. As Biden leaves office in 2025, not one of those rules has been changed. So the deregulatory structure in banking that was put in place during the first Trump administration is almost exactly as it was then. Not exactly, there's some nuance and there's some, people could argue about it a little bit, but basically it's exactly the same. And so now, back to what happened, what the heck happened in the 2024 election with those background facts and history. So what were the key drivers of the 2024 election? You know, there's lots of debate about lots of things, but two economic drivers are clear. First, among lots of other voters, Trump was elected by a multiracial working class coalition. And second, among other reasons, that was due to deep satisfaction with the economy because tens of millions of Americans are hurting. That this was a surprise to so many, frankly, is pretty shocking. You know, James Carville had an op-ed in the New York Times on January 2nd titled, "I was wrong about the 2024 election and here's why." Quote, "I've been going over this in my head for the past 2 months, all the variables, all the what ifs. I keep coming back to the same thing. We lost for one simple reason. It was, it is, and it always will be the economy, stupid." And he went on to say, Mr. Trump, for the first time in his political career, decisively won by seizing a swath of the middle class and low-income voters focused on the economy. It's mind-boggling that this was a surprise to anyone. That it was and is still the economy was no surprise to better markets. You know, the president dropped out on July 21st, and on July 27th, just 6 days later, we said the bottom line is that most Americans are really hurting, being squeezed from all sides, and just not able to make ends meet. They're not treading water. They're falling behind. They're under pressure. They're fearful for the future, and they're desperate for help. And it's particularly true for low and moderate income Americans and communities of color. Close quote. Now, that didn't require a crystal ball or any special powers. The evidence was overwhelming, widespread, and frankly obvious. This is the same day that Biden dropped out. The headline in the Wall Street Journal, American borrowers are on shakier ground. Years of high inflation and interest rates have left consumers mired in debt, even as overall economy hums. This shows the interest paid on U.S. debt as a percentage change from a year earlier. Now, this is 2 days after Biden dropped out and Harris announced her campaign. 39% of Americans worry they can't pay their bills. And breaking down that 39% of Americans who worry they can't pay their bills, 52% of Latinos, 46% of Blacks, and 55% of those making less than $50,000. Now, to put that 39% in perspective, that is higher than any time during the Great Recession after the 2008 crash. During that Great Recession, this number peaked at 37%. That is an astonishingly high number, that 39% of Americans were worrying in the summer of 2024 that they couldn't pay their bills. And many Americans are living paycheck to paycheck. Bank of America did a pretty thorough study that was just published in October that showed while living paycheck to paycheck is difficult to measure, this study showed that almost half Americans consider themselves living to paycheck in the third quarter of 2024. And here, credit card debt hit a record $1.17 trillion as of September 30th, 2024. That was an 8.1% jump year over year. And the average interest rate on that debt is about 20%. And of course, it's a lot higher for subprime borrowers. Those are the people below $50,000 often. Now, this credit card users paid nearly $164 billion in fees and interest in 2022 in just 12 months. Think about that. And more shockingly, that was up from $120 billion in 2018 to 2020. That was an astonishing increase of $44 billion, or almost 40% in just 2 years. And importantly, that wasn't just due to the Fed raising rates. The APR on credit card reached an all-time high in 2022, and credit card interest rate margins also hit an all-time high. They jumped from 16.4% in 2021 to 22.8% in 2023. So think about that. While the Fed was jacking up interest rates, banks and credit card companies took advantage of that to increase their margins. And so the American people who are already on the knife edge economically are paying 40% more in 2022 than they were in 2020. So look, it's not a mystery yet. The headline economy looks good, but the real life economy sucks. That's not a mystery. Those facts were everywhere. And so that enormous, unrelenting, crushing economic pressure is what Americans were facing in 2024. And that's why we said what we said on July 22nd. Frankly, we said it long before then, and we said it after then. Importantly, this wasn't something new in 2024. It had been going on for a very long time. This shows you wealth from the top 0.1% to the bottom 50%. And this shows it quite a little bit differently. 67% of the wealth of this country is owned by the top 10%. That little sliver, the bottom 50%, 2.5% of the wealth in the country. That shows it's not a wealth gap, it's a wealth gulf. And that has an impact on the daily lives of everybody, because that means well over 50% of the American people have no cushion, nothing to fall back on. They're living paycheck to paycheck and falling behind. And that gulf is growing. Here we have recently Wall Street bankers on course for a 35% bonus bump. Wall Street wins again. Here, private equity is going to go up 33%. Finance is grabbing more of the gains again. This is what has been happening for a very long time while Main Street families have been suffering. This chart shows that just 13 months after the Lehman crash in September of 2008, the real unemployment rate, the U6 rate, reached 17.2%. That was almost 27 million Americans were out of work. Because many of them were heads of households, this impacted about 50 million Americans. Now you can see what this chart shows you is that it took 10 years before the unemployment rate returned to the pre-2008 crash levels. And during that time, well, this shows you that Wall Street paid itself $22.5 billion in the calendar year 2009. That was a 28% increase over their 2008 bonuses, even though they caused the crash and were bailed out by the very same people who they threw out of work. It then paid itself tens of billions of dollars in bonuses year after year after year after the 2008 crash, the bottom line, while Main Street Americans suffered, which is the green lines. And this only shows the New York City bonuses as tracked by the New York City Comptroller. The actual bonuses to the financial industry were many multiples of this. And here's another thing that's important to know about the crashes. This is not a left-right issue. It's not a Democrat versus Republican issue. Financial crashes hurt everyone. This is truly a nonpartisan issue, no matter how much some want to make it partisan, and the media just can't get out of the left-right, Democrat versus Republican frame for everything. It's not true. Red states, blue states, high unemployment. New York's rate was 14.8%, Texas 14.5%. A financial crash doesn't care whether you vote or not and who you vote for. Now, here's another way to look at the cost of the crash. You'll hear everyone talking about the deficit and debt and how we have to cut spending, but you'll never hear people talking about where the deficit and debt comes from. And this shows you what happened to the deficit and the debt after the 2008 crash. Ultimately, the crash is going to cost the country, or did, probably mostly run through now, but more than $20 trillion in lost GDP. And to give you some sense of that, the GDP in 2007 was only $14.5 trillion. Now, what was the Main Street economic result of the 2008 crash and industry bailouts? And I have to tell you, this is shocking but true. The bottom 90% of Americans were poorer at the end of 2016 than they were in 2007. These aren't Better Markets numbers. These are objective numbers that are widely known, and they were poorer. That 90% was poorer in 2016 to 2007 by between 17 and 35%, almost a decade after the crash. So the bottom line is that America lost an entire generation economically, and that also grievously damaged faith and trust in government, elected officials, and democracy itself. So what was the Main Street political result of all that in 2024? Well, you've seen the headlines and the data, but here's two. For minority working class voters, dismay with Democrats led to distrust. And, raising questions, is this the end of the white working class Democrat? We've all seen the headlines. People voted on economics. That people were shocked about it is really mind-boggling, as I said. Now, it's not just us seeing the many connections and drivers between the economic conditions before and after the 2008 crash and the 2024 election. This is Don Baer, the former White House communication director under Bill Clinton in the 1990s. He said on November 18, 2024, Mr. Trump is amplifying the populist resentment that has grown since the days of the financial crash of 2008 rather than trying to ameliorate it. So how did we get here? As I said earlier, there's lots of reasons, but a key structural driver is because the financial sector is using its economic power to buy political power that it uses throughout the policymaking process to protect and increase its economic power. Now, of course, they're always claiming otherwise, but it is often at the expense of everyone else. Now, worse, the financial system is often little more than a wealth extraction mechanism for the few already rich, rather than a wealth creation system for the many. When you saw the timeline earlier, that section between 1950 and roughly 1980, a little bit earlier than that, that was a wealth creation system for the many, when the highest, deepest, broadest regulation of the financial industry in the history of the country. So Wall Street and finance more broadly focus too often on the high margin, financialized, and often subsidized activities that enrich financiers in the top 10%, not enough on the crucial but low margin lending activities that benefit Main Street Americans. Now, how do they do that? You say, my gosh, right? Well, basically by buying deregulation. They bend the laws, rules, and regulations to increase their profits at the expense of Main Street and the public interest. They do it through the campaign system. They do it in Congress. They do it at the White House. They do it in the media, and they do it in the regulatory agencies. And here are the financial regulatory agencies. Well, people see to some extent what's going on in campaigns and on the Hill and in Congress. Very few see or are aware of what's going on at the financial regulatory agencies, even though that's where a lot of the industry's deregulation wish list comes true. Now, that's why understanding this is key to understanding the economic conditions facing and driving American voters in 2024. 32 years of widespread deregulation coming up to today. So when you hear the cries of overregulation, remember this chart. And that's why Trump's coming deregulation juggernaut is so important. Mark Twain is attributed this quote, although there's a dispute over that. But history doesn't repeat itself, but it often rhymes. However, there's a very high probability of history actually repeating itself here. Financial crashes have happened before under very, very similar circumstances. Here's Trump's deregulation juggernaut. Massive financial deregulation leading to a jump in financial risk-taking is coming. At the same time, protections for investors, customers, consumers, markets, and financial stability are being weakened, gutted, or removed. And that's going to lead to financial crash, bailouts, and massive pain on Wall Street. And when I say it's happened before, this is George W. Bush's banking regulators or deregulators in 2002, allegedly claiming to be cutting red tape, which is what they call some of the most basic and important protections. Here's a quote from Chief Executive of Citigroup in July of 2007. When the music stops in terms of liquidity, things are going to get complicated. But as long as the music is playing, you've got to get up and dance, and we're still dancing. And that means the fruits of the deregulation that you saw in that timeline were paying them enormous amounts of money. In 2007, finance captured 44% of all corporate profits in the United States. Think about that. Finance is supposed to be a support for the real productive economy. And yet in this case, finance was gobbling up what was supposed to be the corporate profits of the real economy. 44% went to finance in 2007. Of course, what happened? The 2008 crash that shook the world and wreaked devastation on our country. The music stopped, and basically all the major financial institutions failed in 2008 as a result of and directly related to decades of deregulation. Now, this is Trump's deregulators in 2017. Trump deregulated 2017 to 2020, and it's important to understand that there's always a lag between deregulation and a crash. And it's always unclear how long that lag will be, but this is what we had going on. They claim, oh, we're going to cut red tape again. Red tape, never telling you that what the red tape are critically important protections. So Silicon Valley Bank fails, and we have a banking crisis in 2023. And that's a direct result of the deregulation during the first Trump administration, and a good illustration of the lag between deregulation and a crash. It took about 4 to 5 years between deregulation and the crash. 2023, 3 of the 4 largest bank failures in U.S. history, with all the banks, bankers, creditors, and depositors getting bailed out. The American people got the bill, and that bill was $40 billion in direct bank bailout costs, and the all-in cost to Americans due to the credit contraction and other downstream effects is going to exceed $300 billion. This report detailed how deregulation at the Fed led to the crash of Silicon Valley Bank. Unfortunately, the deregulation giving rise to those failures were not addressed. There were band-aids put on the problems, and those problems are all going to get worse in the coming years as they overlay additional deregulation on top of that. Now, how? Because Trump's promised massive deregulation, and he's appointing and nominating people committed to deregulating deeply and broadly. And this is just one example. The head of the Chamber of Commerce in the Wall Street Journal on November 11th, just days after the election, let the Trump deregulation begin. Now, make no mistake about it, this is great for Wall Street. You know, Donald Trump's policy pledges unleashing animal spirits, Wall Street bankers say. And here we have Jamie Dimon says Trump's plan to loosen regulation have bankers dancing in the street. Well, I caution you, when you hear Dimon and others saying that, remember what Citigroup CEO said in 2007, right before the crash in 2008. You know, as long as the music's playing, you got to get up and dance, and we're still dancing. Wall Street bankers dancing is not a good sign for Main Street Americans. And deregulation this time could even be more extreme during Trump 1. This is a report that Trump advisors seek to shrink or eliminate bank regulators. Now, let me be clear. I'm not saying every regulation is perfect. It's not. I'm not saying that regulation can't be improved. Of course it can be. I'm not saying every regulator is needed. That's certainly not true. But when we think about the thrust of what is happening here in a deregulation and an anti-regulation ideology and mindset, there's nothing good coming from that, and it is layered with dangers. Now, what are the coming economic, financial, and political consequences? History shows deregulation of the financial industry will be bad for Main Street Americans. They're going to be ripped off more and have less protections and recourse. And worse, it will create a short-term boom over the next couple of years, and it will be a sugar high, and the clock will start ticking on a coming catastrophic financial crash that very well could be worse than 2008. Now, when and how bad, no one knows. As I say, there's always a lag, and there's many variables that impact both the when and the how bad. But history might just not rhyme this time. It might actually repeat. And I guess, I don't know if it'd be poetic, but 2029 is the 100th anniversary of the 1929 Great Crash. And remember, again, you think about what John Mack said. We cannot control ourselves. He is right. The financial incentives are too gigantic. Human beings cannot be expected to control themselves when the short-term, unimaginable riches are potentially available to them. So, the evidence of the truth of John Mack's statement is everywhere. Unfortunately, no one is listening. In fact, they are arguing just the opposite. And no surprise to anybody who pays attention, JP Morgan Chase's CEO, Jamie Dimon is in the lead. So this is on October. Jamie Dimon says, it's time to fight back on regulation. He's been whining for years about over-regulation since the Obama administration had the nerve to re-regulate for a couple of years modestly after decades of deregulation, after the worst financial crash since 1929. The bankers went ballistic and fought every bit of that, and they continue to do so. And keep in mind, this complaint is after very modest re-regulation, and notwithstanding that history proves the opposite. Again, I urge you to think about this in a longer time horizon. Okay, so Jamie's crying about regulation and he has to fight back against it. That's in 2024. Place that on this timeline. 2024 is at the very end. Look at what came before. There's almost nothing to fight back against. So when you hear these cries for deregulation, go back to the timeline and remember also the economic carnage that's caused by that deregulation. 10 years of unemployment from coast to coast. We lost literally a generation of Americans were economically crushed by that last crash. This is what it did to the budget. Oops, sorry. So last time, there was zero accountability for any of that after 2008. Not on Wall Street, who did it, not office holders, lobbyists, the regulators or lobbyists in Washington who enabled it, and not in the media who were cheerleaders for it and pocketed profits from the financial firms. And then you have the 2023 banking crisis, and the same thing happened after that. Again, zero accountability. That's called moral hazard, and it's never been higher. It's incentivizing more and more dangerous risk-taking. At the same time, another wave of deregulation is coming. Now, that lack of accountability is not likely to happen next time. Remember, the Tea Party actually began as a revolt against the Wall Street bailouts before being kind of hijacked by others and redirected. And there was the Occupy Wall Street movement that was also quite important for a period of time. So people did take to the streets last time, on the left and the right. Now, ultimately, ineffectively, and to no lasting visible impact, although I know some people involved in Occupy Wall Street disagree with that. But the anger last time was widespread. There was a collective action problem. The public couldn't find a vehicle to express and channel their anger. Obama was no FDR, and he was surrounded by Wall Street Democrats. Next time, that's not likely to happen. The seething anger just under the surface is apparent for all to see, as is what happened when it burst into public for all to see very recently. And that gets to this: wanted posters targeting healthcare executives after the assassination of a healthcare executive. and they mysteriously popped up in New York City. And I don't know if you saw this in the media, it didn't get a lot of attention. But in New York City, there were signs saying Wall Street CEOs should not feel safe. Um, Now, despicable act. Hopefully, they have the right person who will go to jail for a long time and pay the price that he should have paid. Um, but you have to note the anger wasn't just aimed at healthcare industry or executives, and this should really concern everyone. Now, last time, this is a quote from President Obama in 2009, and I'll be wrapping up very shortly. My administration is the only thing between you and the pitchforks. On Wall Street, in finance, or I'm sorry, I'm having a technical problem here. Um, the consequences next time aren't likely to be the same. The American people are likely to suffer much more, and it's hard to see them standing by for zero accountability. They're not going to sit there and see no accountability on Wall Street, no accountability in finance, and no accountability in Washington after the next crash. Oh, look at this. Now it works. Sorry, I'm having some technical issues. Um, and so that's frankly why now is the time to fight back against needless, baseless, and mindless deregulation. Now is the time to fight for a financial system that really supports the productive economy. I understand that's not where the political winds are going. I understand that's not where the power and money of Wall Street is going. That's certainly not where Jamie Dimon and his fellow Wall Street CEOs are going. But for the country needs people to fight back. Deregulation is proven to devastate Main Street Americans. It's a historical fact. You can argue about how they apply, but it's going to happen again if there's another massive wave of deregulation put on top of all that other deregulation over the decades that I just showed. And fighting back now is the time if we're ever going to get an economy that supports the productive activities of our country. And that's key. Well, I'm sorry. It's a time to fight back for a financial system that really supports the real productive economy. And that's key if the economy is going to work for 90% of Americans and not just the top 10%. Thanks for listening. I hope you found it informative. We'll be posting a version of this online in the coming days. But remember, we covered a lot in a short period of time. So I wanted to caveat that means some things we skipped over, some things are oversimplified. There's a lot more nuance to these issues than could be covered today. But we wanted to share our views on these because so many people have asked us about the election, what happened, what we thought were drivers at the election, what's happened since the election, what we think is going to happen during the Trump administration. And at a very high level, these are our views as of today.